welcome to Money, Money, Money. It's that time of the year when you're probably wondering if you've done all you can to save tax. Yes, the financial year is on its way out, so we've decided to make life a little simpler for those of you who are somewhat behind the curve via this last-minute tax planning special edition of the show. Now, we will get you the tax checklist as well as the answers to all of your tax queries right here on the show. Let me start by welcoming my guests. We have Mayur Shah, Partner Tax at EY, and also Harshvardhan Roongta, who is a well-known financial planner. Thank you, both of you gentlemen, and thanks for joining us on the show. Now, before we get down to the questions, I want to get some of those hygiene elements out of the way. I mean, a lot of people would be prudent planners and would have taken care of their ATC limits and ATD limits, etc. But I want to start by getting your sense, Mayur and Harsh, on the basic exemptions that are available that people should keep in mind. Before we even talk about exemptions, the definition of income. And Mayur, let me start with you over there. For a salaried individual, salary, of course, forms the bedrock of income. But what are the other areas of income which we should keep in mind? Because the taxman will probably come after those sources of income as well.
Sure, and you are absolutely right. It is very important to understand the definition of income in terms of what will be subject to tax and what will not be subject to tax. So interestingly, apart from salary, there are other four heads under which income generally gets taxed. One is income from house property. We all know that first house property will be considered as self-occupied and there is no income which is getting taxed. But if for the investment purpose you hold another house property, that will be deemed to have been let out and it would be taxed even if person is not deriving any rent therefrom. The other thing is, very importantly, is that, if any gift which are being received other than from relatives, in such a case, if such gifts are in excess of 50,000, would be subject to tax as your own income. And you as a recipient of gift would liable to pay tax thereon.
Now, Harsh, what's your experience? I mean, I know it's the last few days of the financial year left. Do you think people have become more tax prudent and people usually have their house in order? Or do you still have some clients coming your way saying, I haven't saved tax, is there anything I can do?
Absolutely, Surbhi. In fact, if you look at a scenario where situation one is there's a salaried employed. So, there is a deadline given by their employer to submit investment proofs. So
which is why there's discipline at least, yeah.
So that is, most of them in and around that much time, during that deadline, complete their investment planning for taxation purposes. For business employees, for people who are into business and self-employed, well, these people tend to come right till the end of, the last day, which is 31st March. Because of various reasons, they're trying to look at all the adjustments that they can do in the, what is the impact of tax on their books. For them, another deadline is the advance tax, the filing date, which is 15th of March. So they come around that time and they just try and assess their income and finish up all their tax saving products. Now, what is important is, if you are going to wait till the last moment, you're invariably going to buy something which is conveniently available to you rather than what you actually need to buy. So this is one element which people tend to overlook when they plan only for taxes and not from the investment or financial planning goal.
Sure, absolutely. In fact, we're going to talk about the self-employed individuals as well a little later on the show. But let's start by understanding the exemptions and the deductions that are available. Let me start first with the investment category, Mayur, because the ATC limit is so bundled. Your ELSS and, your ULIPs and PPF, debt, equity, everything comes under it. But help us understand which are the specific investment vehicles or instruments where I can save tax.
If you are an employed person, normally it is being taken care by PF because invariably your contribution to PF is more than the limit which has been prescribed. So, you would exhaust that limit.
That's the EPF or the infamous EPF after Budget 2016, should I say.
That's exactly. Apart from that, you can make investment in NSE, PPF and ULIP, all insurance, other insurance product, ELSS. So all such items which are available for from an investment point of view. Apart from that, you can also invest in deferred annuity or annuity plans or pension funds, which allows you to have a security from retirement perspective. At the same time, your investment goes in and it earns income but does not get subject to tax thereon.
certain deductions that are available under the heading of health. Now, you get deductions when you buy health insurance, as well as in case you have certain disabled dependents, or you've taken care of certain dependents in certain specified categories, disease categories, etc. So if you could throw some light on that.
Yeah, so if you have a dependent disabled person, if you incur any expenditure on medical treatment for such persons, you get enhanced deductions for such medical treatment. Apart from that, if you have parents and if you are incurring any expenditure or you are paying any premium for them, you get an additional deduction even for that as well, apart from your self and family members.
But Harsh, I mean, how beneficial are some of these deductions available? Do you find people actually availing them, or is the awareness level still a little low?
Now, when you speak about specific provisions under, say, probably Section 80D, which covers Mediclaim premium, so, well, it is a popular section.
That's a well-known section.
It's a well-known section, and people do take full advantage of that. In fact, we have seen people come, and you have a choice. Let me put it like this to you. There are certain policies in which the premium even goes to about, say, 50,000 rupees, considering the entire family put together. Now, each individual is eligible for a deduction up to 25,000 rupees. So, we have two members paying 25,000 rupees each for the same policy. So both of them can claim a deduction under Section 80D.
And what about in cases of where there is a disabled dependent, or if there is specific critical illnesses? Which are the illnesses that we're talking about?
So when we talk about grievous illnesses such as say, possibly treatment for cancer or treatment for prescribed ailments which are very serious and grievous in nature. So those are classified under those particular sections. One important addition that I'd like to make.
This is 80 DDB is what we're talking about, specified illnesses.
Absolutely. Section 80 DDB. Now, in addition to all the investments that we've done for Section 80C, we just spoke about that, there are certain expenses that we incur which also qualify for deduction under Section 80C, such as if you're paying tuition fees, full-time educational course, if your children are pursuing such course, you're paying your school fees.
Sure.
Those also qualify for deduction under Section 80C.
Sure.
Now, what happens is, if you're not aware of that particular provision, you are actually paying the fees for your children's education, but you don't, because you've come last moment, you're such in state of panic that you need to submit something, whichever. So you land up buying some investment in addition to knowing that there are already certain expenses that you've incurred, like your tuition fees, as I mentioned. Then there is the principal that you pay for your housing loan.
Yeah. So housing, I was coming to. I mean, those are slightly well-known categories. If you've got a housing loan, you get a deduction on both the interest component, which is 2.5 lakhs if you're going by the new year budget. That's of course a new financial year. There is also the reduction available on the principal amount, and then the education loan also, of course, as we've spoken about. Anything else that we're missing out, Mayur, in this list? Any other categories or any other events you might have, gone through in the year on which you might be eligible to claim a tax deduction?
Sure. See, another item which we normally miss out is that, any installment which you pay, not for repayment of loan, but for a property which is under constructions, those are also eligible for 8IC deductions, which we normally don't know, except the initial payment which you are booking for allotment of a property to you. So apart from that, all the other payments which you make are eligible for deductions, which we generally miss out. Other than that, the another item which we miss out, that investment which are made in past could be yielding certain income, such as NSC, if we look at it. Once we have made the investment, every year you earn some interest thereon, which gets automatically reinvested in NSC itself, and that will also be eligible for 8IC deductions. So probably we need to look for those kind of investment which has been made in past, which are even today eligible for 8IC deductions, and we should not miss out, because there you don't need to make any additional investment thereafter. So these are the other aspect which we need to be aware of. Another deduction which one should look out for is that if you have saving account, interest on saving account, or any term deposit, etc., then interest thereon, there is also a deduction up to 10,000 which is available for such income as well.
Okay, so those are the hygiene elements. We're going to take a quick break on that note. More on the other side. Don't go away. Welcome back here with Money, 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 and this is the year-end tax planning special. So we've been solving some viewer queries, and as promised, let's now talk about the non-salaried class as well, gentlemen. Of course, people who are self-employed, who are working on contract. What are the legitimate deductions they can keep in mind? Of course, there's they can claim a lot of deductions as showing it as business expenditure, but some of the major heads that one should remember.
So major expenditure for small businessmen is, they have salaried employees, their actual salary, generally what we have seen being paid in cash, but never recorded. I think these are all legitimate deductible expenditure one should claim. Also, conveyance and other related expenses such as, freights, transportation cost, or meeting with their suppliers, vendors. All these costs are eligible for deductions and one should claim that. Also, there are a couple of more deductions one can think of. Is that if you are a self-employed person and you are staying in a rented apartment, you can claim deductions up to 2,000 rupees per month for rental expenses which is being incurred by a person. Also, we can talk about, that if you are earning any saving interest, then you can get a deductions up to 10,000 for such interest. Sometime or many a times we have seen that, when you have income from other sources where you have made investment in some securities, but that investment has been made out of borrowed fund. So whatever interest you pay thereon can also be claimed as a deduction from such interest income which you have earned on account of investment made. Okay. So one can claim those deductions as well while filing the return.
Harsh, you had a point in mind, you were mentioning something.
So, well, if you're staying with your parents, it's very well within the system that you actually can even pay them rent and claim that as a deduction in your income.
Okay.
So it's not really out of the system. You're not doing anything which is not right. You can pay rent to your parents and claim that as a deduction for your housing rent.
So then, gentlemen, final thoughts and final tips perhaps for our viewers. The key things that one should keep in mind as you're scrambling to get your tax house in order. Harsh, I'll start with you.
Well, Surabhi, if you look at investments and tax planning, ideally they're two different things. We tend to mix both of them. Let's look at a scenario at the beginning of the year. You have a reasonable sense of the income that you will generate for the that coming year. Now, if you know your income, or at least have a sense of the total income that you're going to earn, there are certain provisions under the tax laws which help you save tax. Why would you wait till the last day to save and invest for saving tax? I don't understand this logic. Now, the second element you should keep in mind very clearly is that never invest only to save tax. Now, assuming that you want to take only the tax benefits and you, for that purpose, taken a housing loan, and you've, otherwise investing into a house was not on your list of to-do things. Now, you started investing only to save tax.
Yeah.
Going further, say possibly 3 years down the line, if the Section 24, which gives you deduction for interest paid on housing loan, is completely taken off, then what do? The third element you need to keep in mind, your financial planning is your ultimate objective of saving and investing money. So if there is some goal that you have for the future, you invest for that, and every category of investment has a tax saving element to it.
So on that note, Mayur, final thoughts with you. What are the biggest tax mistakes that you've seen people make?
What you should eye on is that what are the expenditure which are available for deductions which you can legitimately claim. We should just think about it. Plan your affairs in a manner that you record and keep all those handily available with you. The other aspect is that you should look at the kind of income which you have. Like there are long-term capital gains arising on sale of properties, immovable properties. Are we investing in a right way so as to gain benefit from taxation? So while we are doing a transaction, before the transaction is done, we can think about how we can make it more tax effective. Tax planning, doing legitimately, I don't think is a challenge, so far as there is a commercial reason for doing such a transaction.
We're going to take a very quick break on that note, but when we come back, we'll get specific to your queries and your questions all about tax saving and tax planning in this episode of Money, Money, Money. Welcome back. The clock is ticking. Yes, we're moving towards the 31st of March, and that's why this is the tax planning special on Money, Money, Money. Well, we've been in conversation with our guest, but joining us now is a very special participant on this show. We have Anshul Jain, who's one of our viewers and who's been watching and who's been responding in with his own tax query. Anshul, I believe you are a working professional from the city of Mumbai.
Yeah.
So welcome to the show and thanks for coming in.
Thank you.
How can we help you? Do you have your tax house in order for the year that's ending?
Not at all. I have a lot of queries on taxation.
Go right ahead then.
Okay, so first thing, so my annual salary is about approximately 15 lakhs, and TDS is deducted by my employer directly every month. I do not have any other source of income. Do I still need to file my IT return?
Yes, I would say so. The reason being, what the rules say is that if your gross salary, without claiming any deductions, is below the threshold limit, then you are exempted from filing your tax returns. But in your case, that is not the scenario, so you would need to file your tax returns. In fact, I would take one step further and tell you it is in your own interest that you file your tax returns, because this document not only entitles you and it gives you a clean chit with the income tax department, but even otherwise is used in many other places. In case you wish to avail of a housing loan tomorrow or any kind of borrowing, you need to prove your credentials, and which your income tax returns help you with.
So no escaping the taxman. You've got to file your returns.
Yeah.
Anything else that you have on mind for this year?
Yeah. So I think one more query on I have. So I own a car and I use it for my official purposes, but my employer reimburses my fuel and maintenance expenses. Now, do I need to include that as part of my income, or that is just like a reimbursement?
Mayur, would you take that up?
Yeah. So as far as company provided cars are concerned, the taxable value is much lower, which is around 40,000 per annum. Whereas if you use your own car for official purpose and without maintenance of documentation, the exemption which is available to you is only of 40,000, and balance reimbursement would be regarded as your income and will be subject to tax. Unless you are maintaining logbook for official as well as personal use and is being certified by your employer, in such an event you can get a higher deduction depending upon the usage of car for personal as well as official use.
Any other query? Any other
So I think last, so I've actually not filed my return for year end in March 15. I've missed on that. So can I still file it, or do I within the time limit?
Yeah, so you have already missed the timelines within which you have to file the return, and therefore you
That sounds scary, but is it scary? Is it that scary?
It is not really scary.
Okay.
Because what you have to do is, and it's a discretionary penalty which tax officer can levy if you are filing after 31st March 16 for March 15 return. And that penalty is only 5,000 rupees. But certainly it's a discretionary penalty which a tax officer can decide to levy. Generally, we have not seen tax officer has been lenient and they don't levy any penalty as such. The other aspect which you need to be knowing is that by when then I should file my return. You have to file your return by 31st March 17.
Okay, Anshul, hope that answers your questions, and thank you for joining us on the show.
Thank you.
Well, we also have another viewer who's joining us on the phone line, so let's try and connect with him. I think we have Vishal Khandelwal with us. Vishal, hi, can you hear me?
Yeah, I have questions. In 2008-9 assessment for the year, for which the assessment year was 9 and 10, while submitting my ITR online, I forgot to mention this 1.5 lakhs rupees of amount as which I can claim under ATC, while my Form 16 specifically state there is no tax demand, and if I consider this ATC amounts which I have invested in insurance policies and then this 5 years long FDs, but unfortunately while filing it online, since it was my first ITR filling on the system, I forgot to mention with the understanding of that since it is already part of my Form 16, so hence the details need not to be updated on the system. And for that, I got a generated of tax demand from the IT department is around 31,000 rupees. I don't know after 5 years whether it is acceptable by the IT team or whom should I pursue with this matter.
Well,
or at all I have to pay the demand and close the matter.
Well, you've called on the right show because we have Mayur here to help out. I don't know, Mayur, what his options are, because it's already been 5 years. He had, very legitimate deductions that he wanted to claim under ATC, but an error over there. And now this tax demand has come. What should he do?
Sure. So there are a couple of ways one can do it, but are we eligible now, given the time has passed by? So if any error which has happened while submitting the return, that can be rectified by revising the return. Now the revision has to happen within 2 years' time from the year in which you have filed the return.
Okay.
Now we must have exhausted this time limit. We are now way ahead of the time limit. So therefore, we may not be able to revise the return. I'm not sure whether the return has been selected for scrutiny or not. If it is selected for scrutiny, you can make a claim before the assessing officer, giving appropriate documentary evidence, and he should be granting those benefit to a person. But if this is not possible, probably one can make a rectification application to the tax officer. They are not bound to rectify it because such application needs to be made within 4 years from the error which has occurred. So when the order was passed, at that time, you could have made an application within 4 years. Now, if you have missed this deadline as well, then probably, we might have to write to Central Board of Direct Taxes to consider it.
Okay.
And they, under their discretionary power, they can consider it. And one has to just explore this possibility then.
So Vishal, your best bet is catch hold of a good CA friend and try and present your case, because it is a factual case, but then the discretion is entirely the tax man. You can't thrust this upon them at all, considering the timelines that are involved. On that note, thank you gentlemen so much for taking out the time and joining us today. We'll wrap up this edition of Money, Money, Money. Thanks for joining in. Our email ID is on the screens, as is our Twitter handle. Keep reaching out to us. We'll be back next week.